We've got concerns. You've got Trump coming in, throwing tariffs around. There's geopolitical tensions already, and they could escalate.
All right, so this is the bit where the media gets to talk about itself.
There is no economy without healthy, thriving communities, without families living with some dignity, without protecting the very systems of the environment that enable our economy at all.
The employer in this case tried to say that I did give him an employment agreement. My wife looks after that and she's usually pretty reliable, so she must have given him one.
Welcome to the Weekly Wrap, where we go over the top video stories from the past week. First up, the Reserve Bank has delivered multiple cuts to the official cash rate and signalled more to come this year. Here's the Dollars and Cents panel to discuss New Zealand's recovery from recession and long-term economic outlook. First to you, Christina. Does the Reserve Bank need to provide another 50 basis point cut?
So what we've seen over recent months is that there's been a continued easing in inflation pressures. A large part of that, though, is also on the expectation that of the interest rate outlook ahead. So to the extent that there are expectations for some further easing down the track, then we do expect that the Reserve Bank will follow through and continue to cut the OCR. Of course, the big question is just how much they will cut. And for our own forecast, we're forecasting that the Reserve Bank will cut by 2 further 25 basis point cuts at the next 2 meetings in April and May. When it comes to the Reserve Bank's own projections, they have 75 basis points worth of OCR cuts over the coming year. So it does suggest that there is the potential for a little bit more in terms of OCR cuts than what we have forecast. When we think about where the terminal OCR is, one of the things to think about is the neutral rate of OCR, the rate at which the interest rates are not stimulating economy or contracting or taking away from the economy. And for that, the Reserve Bank, in terms of its estimation of neutral OCR, has a very wide range of between 1.8 to 4.2%. So that just really highlights the degree to which the uncertainty over just where this neutral OCR is. And to that extent, and also the fact that it moves over time, 3% is around, but about, broadly speaking, where you expect the terminal OCR to be. Our own forecast has it slightly higher than this, but we do acknowledge the risk that it could be a little bit lower.
So does 3% signify a level where the economy will grow again?
So 3% is where where the interest rates are not adding to inflation pressures in the economy or subtracting. And you would expect that it's operating at around equilibrium, which is where you think about at capacity, at around potential. At the moment, because the economy is operating below potential, it's this excess capacity in the New Zealand economy which is driving the continued easing in inflation pressures.
What are some of the risks heading towards the tail end of the year in terms of inflation, global growth?
So when we think about our own inflation forecast, we do have annual CPI inflation peaking at 2.8% in the second half of this year. Now, a large part of that reflects the lagged impact of the decline in the New Zealand dollar that we've seen in recent months. And what we see is that tends to put up the price of imported goods. The most apparent is at petrol prices at the pump, the most immediate impact. But generally, when it comes to the price of other imported household goods, it does tend to be more lagged in terms of that impact starting to come through. So we do see the lagged effects of the lower New Zealand dollar flow through and support a peak of 2.8% in the annual CPI later this year. The Reserve Bank has a slightly lower forecast peak of 2.7%. In terms of the degree to which this is going to be looked through by the Reserve Bank, that reflects will depend on how transitory it sees this impact being. The fact that a lot of it is on the tradable side, it suggests that we do have some leeway to look through the that boost to CPI. And in terms of the risk to our inflation outlook, we do see it as pretty balanced. So on the downside, it's that the downside risk stemming from uncertainty over that growth outlook, particularly over what's going to happen with global growth outlook with those heightened trade tensions. And then on the upside, it is that with that lower New Zealand dollar, the extent to which it will boost the price of imported goods here in New Zealand.
Jared, to you, has the Reserve Bank acted fast enough?
No, I think they could have acted faster than they have. We have an economy which is clearly going through quite a sharp correction, a recession, and monetary policy is still restrictive. So you really need to get monetary policy to either neutral or stimulatory territory to help get us out of this grind.
Are you thinking about 3%?
Yeah, so 3% is roughly neutral, give or take. We should be closer to that than 3.75 where we are today. And if there's anything, you think the Reserve Bank would actually need to put monetary policy into stimulatory territory, which is sub 3.
Edward, how would you categorise the economy right now?
Yeah, very similar to Jared. I think we're in dire straits right now, in need of a boost. The fiscals have been very, very tight, and that's an area. The Reserve Bank is able to drop down the rate a little bit faster and push the economy forward. We still have very, very high unemployment, and it's going to stay that way for a long time. People are struggling out there. We need an economy that creates jobs for working people, and that's not what we've got right now.
So dire straits, you would say, rising unemployment. What else are you noticing?
Well, we still have negative GDP growth, and the Reserve Bank is picking that will be the case at least until the middle of the year, if not beyond there. So the economy is in desperate need of a bit of a shot in the arm.
Jared, what are some of the risks to the outlook?
Oh, there are many. As a small, open nation like ourselves, we are heavily influenced by what happens overseas via our large export sector, and we've got concerns. You've got Trump coming in, throwing tariffs around. There's geopolitical tensions already, and they could escalate. Our largest strength is also our largest weakness in China. They're struggling to grow and facing into the US and others. Our second largest trading partner now, the United States, is on the other side of that. And then our third largest trading partner is Australia, who also gets hit by China. So we are worried about what's happening offshore and what sort of blowback we get.
And those risks include ongoing tension, Ukraine, add to the mix United States. What happens there with Russia?
Yeah, I mean, it's a complicated issue and one that, probably won't be resolved quickly or easily. So that tension continues to build or hold. Then you've got the tariffs, and we're trying to figure out, exactly how that impacts New Zealand. 25% on Canada, Mexico, more on China and other countries, and what does that do for trade here? I've already heard of a company that's importing stuff from China in order to export it to the United States. So where there's a will, there's a way, but we just don't know how it's going to play out yet.
Are you going to probably see a bit more of that?
I think so. I mean, if there's a tariff, people work their way around it. I mean, I think we'll see more and more of that. But the economic analysis is pretty clear when you insert a tariff like that on the likes of Canada and Mexico, that may actually induce a recession there. So, it's something you've got to watch carefully. The risks to global growth are clearly to the downside, and that's not good for commodity prices or our exports.
And there are no winners to tariffs, are there, Edward?
Well, there's in the aggregate sense, there's no winners because they do slow down growth and push inflation through the economy. But you do get people, trying to work their way around them and second guess the tariffs. You get the sort of trade diversion implications, which is, coming from one country to a second country. The third country can benefit from having otherwise lower prices. It is harder to second guess these games when you have somebody in the driver's seat who is very, very erratic and unclear how these things are going to unfold. So hard to pick winners. Worth trying to do what we can, but a very difficult situation in the international space for sure.
And what about New Zealand?
Oh, sorry, I was just going to say, picking winners is one thing. It's also trying to pick what inflationary impacts we're going to have. Quite clearly, tariffs increase in inflation on the countries involved and potentially elsewhere. But we may find ourselves with a bunch of goods that were made in China, destined for the United States, like EVs, washing up on our shores at like a 30% discount. So, there's both inflationary impulse and potentially disinflationary coming through.
And it benefits to firms as well who are able to try and, successfully play the game of shifting their production. I was reading this morning about how a lot of the Chinese solar panel manufacturers have set up large export hubs in Southeast Asian countries, and now Cambodia, Vietnam, and Malaysia are the main exporters of solar panels to the United States. It's the same companies, but just setting up in different places, and they may be benefiting from cheaper labor costs.
So how do you plot a path forward, Edward?
You need a crystal ball if you've got one. It's very, very hard to work out what to do, but I think you need to diversify your trading relations as much as possible. So New Zealand has always put a lot of stock in the idea of getting a free trade agreement with the United States. That's looking further away than it has been in any time in the past decade right now. So making sure we've got other trade partners and we've got other trade opportunities besides raw unprocessed commodities for export as well.
I think that's a great point, and one that I personally have been banging the table about for a long time, is our need to diversify trading partners. I mean, China was the story for the last 30 years. India is going to be the story for the next 30 years. So getting that free trade agreement with India, for me, is the greatest thing that we could achieve near term. And as pointed out, there are other parts of Asia as well, like Vietnam and other areas, which the Prime Minister's having a look at. I think there's some potentially easier gains throughout Asia.
What do those gains look like?
Just having extra markets to export into, but also import some cheaper goods and services from. So, we're heavily reliant on a few countries. Diversifying, as Ed mentioned, I think is a great way to just give us a little bit more safety, a little bit more diversification. It's like a portfolio that you run at home, right? You don't put all your money into 2 or 3 stocks.
Edward?
I mean, we've also had a long reliance on unprocessed kind of raw commodities. We've talked for a long time about the need to diversify that into more processing and domestic manufacturing, but we're up against the barrier at home here of having high and rising energy costs, which are projected to continue rising both because of a failure to invest on behalf of the generating companies and in terms of the transmission and distribution system. We need to get that right, otherwise we are going to be sitting for a long time at the low end of the processing scale, and that diminishes our ability to capture the value of exporting.
I think that energy point is critical, and it's not just a New Zealand problem. Obviously, problems in Europe. There could be a bit of a crisis, I think, on the energy front if it's not addressed adequately. The rise in technology, AI, data centers, all this sort of stuff. They suck electricity, so we really do need to ramp it up, not just for our manufacturing, but also what else is going to go on in the modern economy.
Yeah, I think there are some interesting kind of regulatory settings that we should be thinking about as well there. I mean, if we're trying to attract data centers, that are big energy suckers, then we should be thinking about, making sure that we have the energy to power them. And if that means that we need to have regulation in place saying that if you want to come here and set up a data center, then you need to have some supply contracts in place, or you need to make sure that there's sufficient generating capacity, some investment on that side, then I think that's worth considering as well.
And Edward, do you think the government's current fiscal stance is prudent in the current economic climate?
No, it's excessively tight. I mean, people working right across the public sector are screaming out for more funding to be able to do their job effectively. There's some tough rhetoric coming out about, cuts to back office and frontline and all that kind of thing, and people are wondering what the difference between back office and frontline really is. At the end of the day, what we're seeing is extremely tight budgets are feeding back into a struggling economy and worsening that picture altogether.
Jared, what can the government deliver in May?
Well, I mean, it was point before, it's very difficult. The last few budgets have been very difficult going through a recession like this. What I'd like to see in this sort of go for growth strategy, which I somewhat applaud, is just more spending on infrastructure and the empowerment of councils to get infrastructure done. I'm sick and tired of talking about it year in, year out, but it is one of the biggest inhibitors of this country's productivity. The fact that it takes 15 minutes to get out of your driveway in Auckland, and there's burst pipes everywhere in Wellington. This is inexcusable underinvestment for decades. We need to pick up the ball.
To you, Christina, have you factored in a potential peace deal in Ukraine?
So in terms of what's factored into our forecast, it is very much based on how things are playing out at the moment. So we see this more as we see more largely that downside risk to the global growth outlook, and then to the extent that when we look at consensus economics forecasts in terms of where global growth, there's been downward revisions to a lot of the growth forecasts in our major trading partners, and that's where those downside forecasts, downward revisions flow through to weaker growth forecasts for here in New Zealand.
Do you expect unemployment here in New Zealand to nudge a lot higher, over 5%?
We do forecast the unemployment rate to peak at around 5.5% later this year, towards the end of this year. Now, because of the fact that the labour market does tend to lag broader economic activity, you do tend to see firms react with a lag in terms of what's going on. For example, when there's a weakening in demand, initially there tends to be a bit of labour hoarding going on, particularly in what we've seen with the very severe labour shortages that we've had. Generally, initially at least, there's a reluctance to let go of workers because firms wouldn't want to have to go through that period of severe labour shortage and risk not being able to hire the workers that they need again. But once there is more of a sustained downturn in demand, that's where you start to see firms react and let go of workers. So conversely, when demand picks up, generally firms do want to see a more sustained pickup in demand before they'll commit and hire and increase their the staff numbers. So with that lag that comes through, you do tend to see that play out, and when it comes to the unemployment rate, and we do see a continued increase in the unemployment rate over the coming year. At the moment, a broad range of labour market indicators do point to excess capacity in the labour market. For example, when we look at our NZA, our quarterly survey of business opinion, asking firms how easy it is to find both skilled and unskilled workers. So on both these measures, firms are now reporting that it's easier to find both skilled and unskilled workers. So that really highlights that degree to which there is that excess capacity in the New Zealand labour market at the moment.
Over the ditch, Nine Entertainment owns some of Australia's most famous mastheads, but owning legacy media is no guarantee of success in the digital age. Australian correspondent Lachlan Cahoon breaks down the rise of digital media and the consequences going forward.
I really like this story because it's a fascinating example of the dilemma that the legacy media is finding itself in. I mean, Domain is the digital property platform of the old Fairfax newspapers. I think Fairfax sold their New Zealand interests out quite a few years ago, but they've got Domain, which is the property listings for all around Australia. So it's now part of the Nine Entertainment Group. So Nine and Fairfax merged in 2018. Domain itself was floated on the ASX in 2017. So that float was worth $2.1 billion. And Nine currently owns 60% or so of that company. So we have two main property platforms in Australia. Domain is one, and the other one is realestate.com. I think Kiwis would be familiar with realestate.co.nz.
We are, yes.
That's owned
Yep.
by none other than News Limited, of course. So as we have a duopoly in the media in Australia, so we have a duopoly in the property listings market as well.
Right. So tell us about the situation with Domain. Who is bidding for it and how much are they bidding?
Yeah, so it's an unsolicited bid that came from a US property company called CoStar. They're an information data company dealing in commercial property in the US. NASDAQ listed, worth about 50 billion US, I think. They had a share market raid and grabbed about 17% of Domain, making a takeover, which values it at 2.7 billion. Now, that's a pretty good premium on the share price recently because it's been really in the doldrums lately.
Right.
So I think the shares sort of went up about 30%. So Nine must be pretty tempted. Nine's market cap is only 2.1 billion. So they could walk away with 1.4 billion from selling their stake in Domain. And they have tested the market for Domain in recent years through chatting with private equity companies like KKR. But you know, as I make the point in my column, if they sell Domain off, they get the cash, but what does that leave them with? And I'll talk about that in a minute.
Right, yeah, okay, because Domain has been a bit of an underperformer against that competitor that you mentioned before, realestate.com.
For sure. Just on the share market over the last 5 years, Domain has underperformed realestate.com, which is now in a group called REA. They're listed on the ASX as well. They've underperformed those shares by about 90%. Over the last 5 years. So REA has expanded internationally in other markets, particularly in India. So last year they made a big takeover offer for a UK company called Rightmove, which is one of the big listing platforms there. It didn't come off. So REA is valued by the market at north of $35 billion. And this takeover for Domain is valued at only 2.7. I mean, I read one analyst said that in terms of Australian real estate listing, realestate.com is first and second, and then Domain is way, way behind. So Sydney and Melbourne agents, for example, will list their properties for sale on both platforms, Domain and realestate.com. Elsewhere in Australia, not so much. So both companies had a similar start a few years ago, but the realestate.com platform has gone ahead in leaps and bounds, and it's worth a lot more than Domain.
Right. So, as you said, Nine could be tempted to sell Domain, and that gives them a bunch of cash.
Yep.
But where does that leave the company?
Well, Domain is considered really the neglected child of Nine. It really should have done a lot better. So there's been a lack of cross-promotion with the other platforms. They just haven't leveraged it enough. So, yeah, the question is, what do they do if they don't have a property platform? I mean, this is a company whose main assets are legacy media, free-to-air television and newspapers, old mastheads like the Sydney Morning Herald, the Financial Review, great brands. But as we know, Simon, in the media business, those rivers of gold that we once enjoyed from classified advertising and from display advertising, they just don't exist anymore. So you sell off a company like Domain, which you would think was part of the digital future of any media company, and you're left with the legacy assets. Where do you get growth? I mean, Nine also, to be fair, they do have a online streaming platform, a competitor with Netflix in Australia called Stan. That's done okay. It's got just over 2 million subscribers, and the premium on that is $22 a month, to pay.
Right, yep.
So and that's doing okay, but there's not a lot of growth or innovation elsewhere in the company. And so they're looking at slashing costs, of course, which is what everybody does.
Yep.
But as we know, you slash costs in the media business, and you slash the content, and the content is what brings people to the masthead, and that's what brings the advertisers. So it's kind of self-defeating to do that. They've already flogged off all their regional newspapers and radio stations. So the question I'd have is, okay, sure, you sell Domain, you get $1.4 billion. That sounds nice, but where's the growth going to come from? Are you going to be left just as a legacy media company with these old assets that is going to be surpassed in the coming years?
There's no economy without thriving communities. That's what Greens co-leader Marama Davidson has been reflecting on after going through breast cancer treatment last year. She sat down with political editor Brent Edwards.
Green Party co-leader Marama Davidson, welcome. Look, last week gave you a State of the Planet speech, you and your co-leader. What's this green budget going to entail?
It's to give people hope, because people feel like there is a system that is making it harder for people to survive and to protect our environment. the green budget is to show that we can make the changes that people are wanting, where everyone can live with dignity, where we leave no one behind, including Papatūānuku, our planet. And this is the focus of the green budget. We'll have that care at the heart of it.
Will that mean spending more money than the government currently does, or spending money differently?
It will mean that we do absolutely need a different economic system. So when you have got 311 families who currently hold more wealth than 2.5 million of us, that is not an economic model that we can sustain. It means that children are living in poverty when they don't need to. It means that people are living without a home when that does not need to be necessary. It means that our living systems are being exploited and are not being protected for mokopuna to come. So we can redistribute and unlock the money that we have here in Aotearoa because we have enough to put people and planet at the heart of everything we do.
So do you redistribute by changing the tax system to tax people more on those higher incomes or with that wealth?
Yes, we know that. We have an unjust economic model at the moment that is concentrating wealth into the hands of a few. It means that we miss out on being able to make the proper positive investment into our public infrastructure, into our public services. We know that putting public good and public services ahead of the ability for private interests to continue to exploit our communities and exploit our environment is something that most New Zealanders want to be able to see, and that is the positive way that we can have an economic system that works for all of us.
I mean, the critics argue that you effectively would remove the incentive for people to make more money, and therefore that would have a negative economic impact.
There is no economy without healthy, thriving communities, without families living with some dignity, without protecting the very systems of the environment that enable our economy at all. The best economic system that we can have is one that has strong, healthy communities at its heart, is one that is protecting our rivers and our oceans for generations to come. And I know that there are a lot of economists, businesses, economic leaders who understand that the current economic model is an outdated one, that we need to shift to a longer-term thinking and the wisdom of protecting people and planet at the heart of it.
What's the role of business in the kind of economy that you're talking about?
So much. If I just take one example of one of our local businesses in Manurewa, who, for example, was really in support of increasing the incomes for those on the lowest, so increasing benefits, because he could recognise that people having more money to spend locally was going to be a good thing for his business. We know that when people are feeling in control in their communities, that they are not just struggling to get by, that always has an impact on local businesses. We know that so many business leaders here in Aotearoa have been calling for economic transformation for quite some time, because they too can see that a wise and a modern smart economic system and economic business model requires that we are looking after our community and looking after the very living systems that we all depend on.
But for instance, would you look to invest more in R&D and technology, green technology, I presume, and the like, to try and lift productivity?
Well, for example, so let's deal with productivity first. Having children being able to go to school and making sure everyone has a kai, making sure that people feel stable in good quality housing, making sure that our hospitals and local doctors are able to deliver healthcare. All of those investments into our public services are an absolute positive for any discussion about productivity. Secondly, we launched a plan. I was on leave, but we launched He Ara Anamata, which is a an alternative emissions reduction plan, just in a plan to protect our climate from further climate pollution. Just in there alone are just multitudes of opportunity for business, for an economic model that will both create more jobs locally, that will support families to have more money in their pocket from the savings that they make. For example, better electricity and energy options for their housing that bring the power bills down. Just in those sorts of examples are massive opportunities for creating enterprise.
This government, the coalition government, is very focused on the state of the government finances, the level of deficit and debt. Are you concerned about deficits and debt?
I'm concerned about deficits and debt of people in their homes and their households, the personal level of debt that people are having to endure when a government refuses to support families who really need it. That's the debt that people are worried about every day. People who, even understanding what the initials GDP, don't know what that stands for, but what they do know is that they are working jobs. They are still struggling to pay the rent and feed their children healthy kai and any medical expenses on top of that. That's what I'm concerned about, and I know that when we've got the solutions to solve those issues, that too will benefit the broader outlook for all of Aotearoa.
So you think if you have a better economic outcome and more growth, that will deal with the government's financial position?
What do we mean by growth? I want to see the growth in Aotearoa that supports all of our families to be thriving well. I want to see the growth in less rivers being polluted, more rivers being healthy that can be swum in, that we can even get food on, for crying out loud. That is the growth that I'm interested in. I want us to move away from the growth of exploiting living systems in a way that damage them for good. I want to see us move away from growth that continues to concentrate wealth in the hands of a few, while people who rent homes are struggling to even pay huge rents, when you've got this government who is supporting landlords with massive amounts of money, while at the same time ordinary families are struggling to pay their rent. That's the growth, and that's the growth in the politics of care that I'm interested in seeing.
Last year was a tough year for the Green Party, but particularly tough year for you personally with health issues. Has that changed at all your approach to politics?
Being away from work for all of those months and right in the healthcare system gave me a renewed and fresh perspective on the power of community. The breast cancer community want to be caring for others in the same situation, want to be cared for in times of struggle. And that just really brought home to me that politics of care should be at the heart of every decision we make, because those are the values that people on the ground in Aotearoa strongly believe in. When people are having a tough time, we try and help out. I saw that through the many different breast cancer community forums that I was a part of, and it just reaffirmed for me that exactly right now the values of care for people and planet is exactly what we should be focusing our energy on, even more so.
And finally this week, are you dismissed when the boss tells you to F off? Tompkins Wake partner Daniel Erickson discusses the importance of a written employment agreement. Here's Fiona Rotherham.
In Toil and Trouble this week, we look at the value of having an employment agreement, even for someone under trial. With me is Daniel Erickson, a partner with Tompkins Wake. So tell us a bit about this case involving Southern Fencing and Raihana McGregor.
Well, what happened in this case was essentially the key issue at play here was whether the employee had actually been dismissed. There was also an issue as to whether or not the employer had given the employee a written employment agreement, as you're required to do under the Employment Relations Authority. But yeah, the worker here was employed under some kind of loose trial arrangement, so the authority did note that, but it also noted that it wasn't an effective trial period under the Employment Relations Act, because there are certain technical requirements you need for a trial period, specifically in the employment agreement, you have to refer to the trial period, and you also have to refer to the fact that if the employee is dismissed within those first 90 days, they can't raise a personal grievance.
So he did go for an unjustified dismissal. But why did the relationship between this Queenstown company and this worker end?
Well, he hadn't been employed for very long, I think, is the first key point. And the employer had received some feedback from other employees that this particular person was spending too long on their phone and vaping while he was meant to be working. Matters came to a head where the employer actually saw him one day on one of the work sites on his phone when he was not meant to be on his phone and he was meant to be working. There was an argument of some sort, and the employee alleged that during the course of that argument the employer had told him to F off, and he said this essentially amounted to his dismissal. Now, as I say, there was a factual dispute about what was actually said, and the authority had to weigh up the two accounts. What it also did was it referred to case law around what actually constitutes a dismissal. And so when you're
if you're told to F off, that's not being dismissed?
Not necessarily. I mean, what the case law refers to is whether there's been an unequivocal sending away. So I guess, on one level, if your employer does tell you to F off, then that can be a dismissal. But essentially, it came down to that weighing of who was right and who was wrong, and the authority member actually determined that the employee hadn't been told to F off. There was an argument. The employer was clearly annoyed and angry about the employee being on their phone, and there had been some swear words exchanged, but there wasn't that sending away.
Go away and stay away.
Yeah, and one of the things the authority took into account was some text messages that were exchanged afterwards, where the employer, to a certain extent, indicated, a bit of a backtracking and said, I'd like you to come back. I'll give you another go. It wasn't the most productive exchange. There was still a few insults hurled around in the text message exchange, but where the authority landed was that there hadn't been this express action of the sending away.
But nonetheless, the employer did get fined and $1,500. Why was that?
Well, for not providing a written employment agreement. The Employment Relations Act is very clear on that, is that every employee must have a written employment agreement. The employer in this case tried to say that I did give him an employment agreement. My wife looks after that and she's usually pretty reliable, so she must have given him one. But what the authority ultimately concluded was that the employer couldn't prove that. So, for example, there wasn't an email from the employer to the employee attaching the employment agreement or anything like that. So it was for that reason that they ultimately determined there wasn't an employment agreement. And the can be subject to a penalty under the Employment Relations Act. The maximum penalty is $10,000, but in this case it determined a penalty of $1,500.
So that's a lesson for other employers to make sure, even if it's a trial,
totally,
to have the paperwork.
To make sure you do have the proper paperwork in place, that you have an employment agreement that complies with the requirements of the Employment Relations Act. But also, I guess, as a practical point, just being able to prove that you've actually provided it to the employee. I mean, the best evidence, of course, is a copy of the signed agreement, but failing that, even if there's an email to the employee where you've sent them a copy of that employment agreement.
How widespread a problem, I just want to touch on this use of his phone and this vaping, how big a problem do you think that is in sort of employment relationships now? Yeah,
I mean, it's certainly an issue that pops up. It's not just phone calls and vaping, but just people doing personal stuff on work time, surfing the internet when they're meant to be working, the phone calls, the vaping, the too much chat is certainly an issue. Because, I mean, an employer can reasonably expect you to be working when you're at work during your work hours. Exactly. I know, shocking. But there is that reasonable expectation. Of course, there's a bit of give and take. If there's a short 30-second phone call during a work day, you probably couldn't discipline someone for that. But if there's a pattern of someone spending too much time not focused on their work, you'd probably go through a process of written warnings, etc., before you could get to a point of dismissal.
And thanks again for joining us. Our news team is back from 5 a.m. tomorrow with the latest business news you can use on mbr.co.nz. See you next week.